Imagine this. You finally found the perfect commercial property to buy. Or maybe an incredible startup investment lands in your lap. It's exactly the kind of opportunity you've been waiting for. There's just one problem. On paper, you're wealthy, but most of your money is tied up in your investment portfolio. So what do? For most people, the answer is simple. You sell some of your investments to raise the cash. But that decision comes with a hidden cost. The moment you sell appreciated assets, you may owe capital gains taxes. Depending on where you live, taxes and other local levies can take a significant bite out of your profits. And that's not the only downside. By selling those investments, you're pulling money out of the market. That means your portfolio loses the power of compounding, the very process that helped build your wealth in the first place. So here's the real question. What if you could access cash without selling your investments or triggering capital gains taxes? That's exactly what one well-known wealth strategy is designed to do. It's called buy, borrow, die. Despite its dramatic name, it's a completely legal wealth preservation strategy that's often used by high net worth individuals and families. The concept is surprisingly straightforward. First, you buy quality investments and let them grow over time. The strategy works best with a diversified portfolio of stocks, ETFs, or other liquid investments, rather than a single risky asset. As your portfolio grows, it becomes valuable collateral. Instead of selling those investments when you need cash, you move to the second step. Borrow. Many financial institutions offer something called a securities-based line of credit. Rather than selling your investments, you borrow against them. Your portfolio stays fully invested. And because loan proceeds generally aren't considered taxable income, you can access cash without immediately triggering capital gains taxes. That means your investments can continue compounding while you still have the liquidity you need. Let's look at an example. Meet Jordan. Jordan has spent years building a large investment portfolio. Most of its value comes from unrealized gains, meaning selling it today would result in a significant tax bill. Jordan needs a large amount of cash. The first option is to sell investments. But to receive the amount of cash he actually needs, Jordan has to sell even more shares because a portion of the proceeds immediately goes toward taxes. Now his portfolio is smaller. Over the next 10 or 20 years, that smaller portfolio has less money invested, which means less compounding and slower long-term growth. Now compare that with the second option. Instead of selling, Jordan borrows against his portfolio. He gets the cash he needs while every dollar of his investment portfolio remains in the market. Years later, his investments have continued growing. Even after accounting for the outstanding loan, his overall wealth can be substantially higher simply because he never interrupted the power of compounding. Now comes the final step, and the reason this strategy has its unusual name. Die. In countries like the United States, inherited assets may receive what's called a step-up in cost basis, depending on current tax laws. In simple terms, the assets are treated as though they were purchased at their market value on the date they're inherited. That means years or even decades of unrealized capital gains may never be taxed. If the heirs decide to sell the assets shortly after inheriting them, they may owe little or no capital gains tax, depending on the circumstances and local laws. Or they can continue holding the investments, allowing the wealth to grow for another generation. Of course, this strategy isn't risk-free. Borrowing against investments comes with serious risks. If the market drops sharply, the value of your collateral also falls. If it falls too far, your lender may issue a margin call, requiring you to deposit more money or repay part of the loan. If you can't, the lender may sell your investments automatically, possibly during a market crash. Ironically, that forced sale could trigger the very taxes you were trying to avoid. There's another challenge. Most securities-backed loans have variable interest rates. If interest rates increase, the cost of borrowing rises as well, reducing the strategy's overall benefit. That's why many wealth managers recommend borrowing only a conservative percentage of your portfolio's value. Leaving a healthy buffer helps protect you during periods of market volatility. The buy, borrow, die strategy isn't a magic trick, and it certainly isn't suitable for everyone. It's a sophisticated wealth preservation strategy designed for investors with substantial taxable assets. And like any advanced financial strategy, it should only be implemented with guidance from qualified financial advisors, tax professionals, and estate planning attorneys. Understanding how the wealthy structure their finances doesn't just teach you about money, it changes the way you think about building and protecting wealth. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you don't miss our next deep dive into investing, personal finance, and the strategies used by the world's wealthiest individuals. Thanks for watching, and we'll see you in the next video.